Hello everyone, my name is Ashley Davis. I'm the developer of DataForge Notebook and author of the book Data Wrangling with JavaScript. In this video I'm going to be talking to you about the intersection of some of the things that interest me most. That's trading, data science, and of course JavaScript. My desire to test trading strategies has been a primary driver of my learning relating to data science and the journey that led to my book. I'm sure I could talk for hours on this topic, but in this video I'm only going to talk about the basics. I'm going to give you a primer on quantitative trading and systematic trading. We're going to look at some code. There's a live demonstration relating to this video, but that's actually another video on YouTube, so I'll give you a link to that shortly. At the end of this talk, I'm going to give you a list of the advanced techniques and concepts that you might want to follow up on later. I need to start by saying that I'm not a financial professional or anything like that. I'm a software developer. I've worked as a developer in the finance industry. And I've also been dabbling personally with this financial stuff for years. But I need to give you a disclaimer. Please don't constitute any of this video as any kind of financial advice. There are many ways to approach trading, and it's a very personal endeavor. You need to educate yourself and be aware of the risks if you want to apply any of this for real. In this video, we are only going to be discussing simulations. So if you want to try out any of the techniques in this video, there's no risk to you in that. But it goes without saying that if you graduate from simulation, and you start trading for real money, then you have to be aware that you can lose that money. This is a rundown of what we're going to be covering in this video. I want to make sure you understand what quantitative trading is. We're going to understand the how and the why of simulating trading. We're going to look at some snippets of JavaScript code to understand how the concepts are applied. I'm going to point you to a live demo in another video, and in that video you can see how to actually backtest an example strategy. At the end we'll have a brief overview of some of the more advanced techniques. So let's start with the most basic question. What is trading? I'm talking about buying and selling of financial instruments. We can trade all sorts of instruments. There's some examples on screen of what you might trade. Personally, I trade stocks, but I also want to get into CFDs or contracts for difference, which are a financial derivative. As an example for this video, I'm going to test a trading strategy against an instrument with the code STW. STW is an exchange traded fund for the ASX 200. If you aren't aware, the ASX 200 is an index for the Australian stock market. The next most basic question to ask is, why do trading? It seems pretty obvious, right? We want to make money. More exactly, we want to put the money that we have to work, using our money to make more money. Well, actually, it's a bit more sophisticated than that. Over time, I want to grow my account and be able to benefit from the effects of compounding. But at the same time, I want to keep my drawdown and risk to a tolerable level. When I talk about risk, what I mean is the risk of losing money. One of the most important aspects of trading is protecting one's capital. But losing money is a part of this game. We need to be prepared to lose money on a regular basis. But we also need protections in place to ensure our losses are limited. We also need to consider how our portfolio would cope with a financial crisis. We should be prepared for the worst and have a plan to cope. Simulating or testing a trading strategy can help us practice our risk management. We use the simulation to try different risk management techniques. We can then decide which technique or combination of techniques works best for our strategy and our personal circumstances. Personally, I like to use a stop-loss rule, among other techniques, and you'll see an example of that in the video of the live demonstration. There are a number of different styles of trading. In this video, I'm talking about quantitative trading. This is a style of trading where we use computations, calculations, formulas, and indicators to provide us with signals that identify profitable trading opportunities. To do this, we need plenty of data, and we need to do some number crunching. In the live demo video, I'm going to show you one of the simplest indicators that you can use as a trading signal. Quantitative trading appeals to me because we can use it to obtain unambiguous and statistically significant trading signals. Systematic trading is another style of trading, and it goes hand in hand with quantitative trading. In systematic trading, a trading strategy is a set of rules. Those rules define when we should buy and sell. You can see there's some reasons why I like systematic trading. A systematic strategy can be put on automatic. For me, that means that after the effort I put into developing it, I can put it on automatic and have it just run autonomously for years into the future, or however long it turns out to be profitable. A systematic strategy helps limit our emotional investment in trading. I don't want my emotions tied to the rollercoaster ride of the stock market. That's not a good place to be. This is a quality of life thing. I don't want my well-being affected by the state of my trading account, and I try to decouple my emotional state from my trading. Now, the last reason is very important. Having a systematic strategy means that we've got a strategy that can be executed routinely and without emotion. And that's the kind of strategy that can be simulated. We can use simulation to test the performance of our trading strategy. Now, I'm a software developer, and I tend to think of this combination of quantitative and systematic trading as kind of a data-driven trading, although that's probably not a name you would hear in financial circles. Before we get into the example, I just want to explain some terminology that you'll hear me using. Whenever I say I have a position on the market or a position on, say, a particular company or an index, that means I have an open trade. As an example, let's say I have bought stocks in a company and I am yet to sell those stocks. That means I have a position on that company. When trading, we can go long or we can go short. Going short is also known as short selling. To keep things simple and to minimize the jargon, in this video, I'm only covering long positions. That's what you might think of as just standard trading. When I say that I'm going long on a company, it really means that I'm buying stocks and later selling them. Entry means to enter a position or take a position. In this video, because we're only going long, entry means that I'm buying. Exit means to exit from a position. And again, in this video, because we're going long, that would mean, in this case, exiting means I'm selling. Once we have exited or closed our position, that means we have conducted a complete trade. The example I'm using in this video is STW, which is the Exchange Traded Fund for the ASX 200. So to get an idea of what we're doing, here's a chart of the ASX 200 for roughly the last year. We can see some potential trades that I've highlighted in blue. The start of each blue section is a buy. Then we sell at the end of each blue section to scrape a profit from the market. So this is what I mean by trade. You buy at the start of the blue section, you sell at the end of it. Now, if we allowed short selling as well as going long, we could exploit both the ups and the downs for a profit. So I just wanted to give you an idea of what that would look like. And so in this chart, I've highlighted the going long as blue and going short as purple. And you can see that we've basically got the entire market here covered, and we're potentially making profit on both the ups and the downs. Well, I'm not covering short selling tonight. I just want to keep things simple, and also short selling, it's more difficult and it's not always available, and it can make our trading more difficult. Well, speaking of difficulties, I didn't really want you to think that this was all going to be a walk in the park. Trading is not going to be easy. There is no magic solution for this, and developing a trading system can be extremely challenging. I didn't want to spend much time on this slide, but I just did want you to see that there's a lot of things working against you. Some things to note: most trading strategies don't work. Many strategies that used to work no longer work. There's plenty of bad ideas out there, more than good ones. And good ideas are often counterintuitive. Your emotions are going to be working against you, and they're going to tend to get in the way. So if you want to do quantitative or systematic trading, you're going to have a lot of these things working against you. It's going to be tough. As if that's not enough, you also need to learn and adapt as the market itself changes. The market is an evolving system. So you're trying to hit a moving target, and just because a strategy worked in the past doesn't mean it's going to work again in the future. I'm a software developer, and you might be a software developer listening to this as well. If you are, you're probably used to working in an agile fashion and working against an evolving technological landscape. So that experience might help serve you here. So how can we test a trading strategy? To test a trading strategy, we have to simulate it. We are using a systematic strategy. It has rules. We need to work out a way to execute those rules against stock market data. We can then record metrics along the way to evaluate the performance of the strategy. In case you were wondering why we should test a strategy, well, the obvious reason is to test that the strategy works. But there's also a bunch of other reasons we can do this. For me, early on, it was about learning the market and building my confidence. I was able to try out various strategies without risking real money. These days, for me, it is more about choosing the right strategy or finding a better strategy. And that's finding a good strategy that makes profit, but that profit is balanced against manageable risk. A trading system is comprised of rules. We apply those rules to systematically buy and sell financial instruments. This slide shows some of the types of rules I'm talking about. We've got the basic rules on the left, and that's what I'm talking about in this video. We're trading long only. We're going to have a rule that tells us when to enter a position. We'll have a rule that tells us when to exit our position. We'll have a stop loss rule. This rule kicks in to limit our losses when the position moves against us. I can't talk about all possible rules in this video. I want to keep it pretty basic, but on the right there, you can see a bunch of more advanced rules that you might want to look into for a more sophisticated strategy. There are actually two ways to simulate a trading strategy. Our first option is called paper trading. Sometimes it's called forward testing. This is a real-time simulation that closely emulates actual live trading. You don't actually need software to do this. You can simulate this manually yourself, although it can become quite painstaking. This technique is realistic, but it's also very slow. It's a great way to get started though, and I recommend trying it when you first start out. I've actually created some software for paper trading that's called Market Wizard. There's a link on the slide. Please feel free to have a look. It's free to use. There's no cost to you in using it. Our next option for testing a strategy is called backtesting. and that's the main topic tonight. That's what I'm going to be giving a live demo of in another video. Backtesting is a simulation that is based on historical data. We can simulate a strategy on the historical past to see what would have happened if we executed it back then. This has the advantage of being much faster than paper trading. It will take minutes or hours to simulate a strategy instead of weeks or months. We do have to keep in mind that this is just a simulation. It's nothing like the real thing, and as I'm sure you have heard, past performance does not equate to future performance. So when we do backtesting, we're essentially looking at simulated past performance. And no simulation is going to be perfect, but this is the best we have next to doing real trading. It is a valuable technique. To do backtesting, we need data. It's fairly easy to get a hold of data, but to get the good stuff, you need to pay. This is a screenshot of a spreadsheet that I have that contains daily data for STW, the exchange traded fund for the ASX 200. This particular spreadsheet contains historical price data from 2015 through to 2017. And this is the data that I'm going to be using in the live demonstration video. There are many types of strategies that we could test. For this video, we need an example strategy that we can look at. I'm going to be demonstrating using a mean reversion style strategy. It's based on the concept of regression or reversion to the mean. In statistics, mean reversion is a phenomenon where variables that have been extended away from their average value will have a tendency to snap back towards their average. You can see what this might look like in the graphic on the slide. The red line indicates the average value over time. Usually this is called a trend line. The black line shows that the stock price is oscillating around the trend line. Whenever it drops too far away, it snaps back above the trend line. We'd like to be able to use this phenomena in our strategy so that we can buy the dips and sell the bounces. What we're going to test in this video, though, is a very simple and naive version of this strategy. There are much more sophisticated versions of this strategy, but for now I just want the simplest version possible. I need to tell you that I'm not actually endorsing this particular strategy or that it's any good. I am actually hoping to trade this strategy myself at some point, but that will only happen after I have evaluated and tested many variants of it and when I'm happy with the result. What I'm showing you now is just one variant, and it's the first and simplest version that I have tested. Are you ready to look at some code? This is the simplest rule I could think of that's based on the mean reversion concept. This snippet of JavaScript code shows a rule for entering a position. It says that when the closing price of the current day is less than the average price, we'll enter the position. In our simulation, that means we'll buy STW. We also need an exit rule. It says that when the day's closing price goes above the average, we should exit our position. In our simulation, this means we'll sell STW. Another type of rule that's important to me is to have a stop loss rule. This allows me to limit my loss on each trade and helps to manage my risk. The first thing you see in the code here is that we have recorded the entry price. We then have a variable that specifies how much of a percent drop from the entry price we will tolerate before we exit. In this case, I've set that number to 2%. We then calculate the stop price as the percentage amount below the entry price. So if the actual price of STW falls below this price during our simulation, we want to exit the position as quickly as possible. This gives us some sort of protection against losses. I should say that having a stop loss isn't important to every systematic trader, and there is actually significant evidence to show that using a stop loss can damage your overall profits. I like to use a stop loss because it makes me feel protected. It assures me, at least to some level, that should a position go against me, the loss will automatically be capped. Now typically I'll implement a stop loss with my broker, and that'll happen automatically so that I can go on holiday and I know that I'll be protected. Should a position go against me, I will automatically get exited out of that position. Now that we have some rules, we can tie them together and simulate trading. In this code, you can see a loop. It's looping over each bar of the input data. In this case, a bar represents a whole day, but each bar could also represent another time period. For example, a bar could be 1 hour if we're doing intraday trading. Or each bar could be as long as a week or a month if we are simulating longer term trading. Inside the loop, we have an if statement. It says that if we are already in a position, then we need to evaluate our exit rule. Otherwise, if we aren't already in a position, we evaluate the code for the entry rules instead. I've simplified things a lot here. This is actually more like pseudocode than real code. The real code for this is actually quite a bit more complicated, but I really just wanted to get you the gist of it because we aren't going to write all this code from scratch. We're going to use my open source API for backtesting in JavaScript that I've called GradeMark. GradeMark essentially does what you see on screen here, but it also does quite a lot more as well. As we simulate trading, opening and closing positions, we will generate trades. To give you an idea of what that looks like, this slide shows you a TypeScript interface definition for a trade. This is actually simplified and I've removed some of the fields, but what remains are some of the main ones. So you can see here that we capture the date of the entry and the exit. We capture the price of the entry and the exit. From the prices, we can compute the profit. For that, we simply subtract the final price from the starting price, which gives us a profit in dollars. We can then express the profit as a percentage of the entry price, and this gives us a way to compare the profit between trades. We can then determine the profit of the entire system by summing the profit of the sequence of trades, and this gives us an idea of the performance of the strategy for a particular set of trades. Now, at this point in the talk, I'd normally be doing a live demo. I've actually recorded that as a separate video, so if you follow the link that you see on screen, you're gonna get taken to that live video, and you're gonna see me constructing the code to backtest this mean reversion strategy. Please feel free to pause this video while you go and watch the other video. Otherwise, we'll continue. To give you an idea of the end result of the live demo, this is just a quick look at the finished notebook. So we're just looking through, you can see the strategy here. Here you can see the trades that were generated by the strategy, and then the analysis of it, a rendering of an equity curve, and a rendering of a drawdown curve. The strategy that I've shown you is only a starting point, and I'll be doing a lot more development and testing of it before I'd ever consider putting real money on it. This slide shows you some of the more sophisticated techniques that I'm going to be trying later with this strategy. To start with, I'll be using a more statistics-based entry and exit. For this, I want to use something like standard deviation of daily movements to know when a movement is extreme enough for me to act on. I would also like to have a market filter. This is an additional rule that says I'll only go long if the market is trending up. Otherwise, if the market is trending down, maybe I'll go short instead. Another rule I'd like to try is only enabling trading when volatility is high. It's well known that this kind of strategy requires high volatility. So I'd like to put that in there and test it to see if it improves the performance of the strategy. I'd also like to be able to pick from multiple instruments to trade, but have them ranked by their tendency to revert to the mean. So I'm using the best instruments and the best signals to do my trading. Other options I might consider are having a profit target, so that I can automatically exit a position when some minimum amount of profit has been achieved, or I could use a trailing stop loss and try to smooth out the risk over time and help protect my capital. So all these ideas need testing, and I can only know if they make the strategy better or worse through testing. So welcome to the world of quantitative trading. I have to warn you, this is a rabbit hole and it takes a lot of time to explore. There are many other advanced techniques and options at your disposal. You have techniques for controlling risk. You can do data mining to find viable parameters for your strategy. There are different testing techniques to try and make sure your results are statistically significant. I could potentially talk about any of these topics in a separate video. So if you see anything in this list that interests you, please feel free to reach out to me by email. Let me know which topics you're interested in so I know what sort of videos to make in the future. Now, I'd just like to leave you with a little bit of advice before you finish watching this video. You've got to start this process by having goals. Know what you want to achieve, know what's important to you. Be aware that simulated performance is ideal. And don't put your faith in it. A simulation gives you some guidelines as to what to expect in the future from a healthy strategy, and it also helps you weed out the terrible strategies, but you can't expect future real performance that's as good as your simulation results. I'd advise you to keep your strategies simple, like how you might try and keep your code as simple as possible, just complicated enough to do the job, but no more complicated than that. Complex strategies can easily be overfit to a particular data set during simulation, and that's going to give you a great result in simulation, but a terrible result in real trading. Now, you need to work on your psychology. You need to be able to follow your rules. Please be aware that your simulation doesn't need to be 100% realistic. You don't have to go to the ends of the earth to get realism. You just need to find a way to get a statistically significant result. So statistics and science is there to help you with that. I'd say continue doing simulations until you're ready to put real money on the table. If you aren't ready, if you aren't confident, if you aren't prepared to lose money, then go back to the simulations and continue your preparation. To make a workable strategy, you need to understand what strategies already exist that you can make use of, but you may need to think outside the box in order to create a strategy that is profitable. You need to be patient. When you trade for real, sometimes you're going to have to sit on your hands for a while and wait out losing periods. It doesn't mean your strategy is broken. It just means you've got to wait for it to come good. You shouldn't be focusing on making the most amount of money. Instead, you need to concentrate on protecting your capital. You've got to focus on not losing money. You need to have good risk management and protections in place to handle your losses. You're going to be looking after your money during the bad times, and in the good times, the market's going to look after you. It's automatically going to take care of you, and you're going to make a profit. And finally, if you're going to write this sort of code yourself, be aware that it can be very challenging, and you have to want that challenge. You're going to need some passion and some determination to get through it. Please use my GradeMark API. That's going to save you a lot of time getting started. Before we finish the video, I just want to circle back to this early slide that shows why have a systematic strategy. I just want to leave you with this takeaway. Have a systematic strategy because it can be automated, it limits your emotional investment, and your strategy can be simulated and tested. Thanks for listening. I'm always happy to talk about JavaScript, quantitative trading, and other things. So please reach out. My contact details are on screen. Have a great day.